I want to show you something that I was showing my money management clients this week, and it kind of sums up what is going on right here. So if you look at that, Bear Stearns is at the top, then Lehman Brothers is in between, and then stock market bottom is at the bottom. What I'm showing you is Bear Stearns happened a year before the stock market bottomed, meaning the implosion of Bear Stearns. 6 months after that, in the middle, Lehman Brothers collapsed, and then about 6 months after that was the actual bottom of the stock market. So what is going on today with Silicon Valley Bank and Silvergate and Signature and now Credit Suisse and probably Deutsche Bank? We don't know yet if it's Bear Stearns or if it's Lehman Brothers. Stick around, we'll talk about it. Hey everybody, RC here with Fearless Wealth, and this is my weekly video. This is where I look at what I believe is most important to make sure that you are retiring strong and that you retired strong. Now, one of the best ways of doing that is making sure that your strategy adapts to what is actually happening. That means no fixed 60-40, 70-30, or 80-20. Now, what I want to do is talk about Silicon Valley Bank because we have to talk about how we got here. Because it's really important to understand if there's more coming, if the market is stabilizing, is it getting more unstable, because this is going to impact everything: stocks, bonds, commodities, and currencies, basically all those asset classes. The only one that I didn't mention was real estate. So let's talk a little bit about Silicon Valley Bank. So the CEO of it, Greg Becker, he's a big part of why this company failed. And back in 2015, he took $500,000 of Silicon Valley's bank money, and he started going to Washington, D.C. and started saying, look, that Dodd-Frank Act that came out in 2011, we want to make it a little easier to get around it. So it used to be that if you had $50 billion in assets at a bank, you fell under the Dodd-Frank Act, and things were very strict, a lot more oversight. But he went to the Senate and to Congress and said, that's too much. Let's have that $50 billion moved up to $250 billion until a lot of that strict, stringent regulation came in, and he got his way. For $500,000, at least what he invested from Silicon Valley Bank, the law changed. 50 Republican senators signed the law. 17 Democratic senators signed it. And then, I was going to say Obama, but Obama signed in Dodd-Frank. But who actually changed the law? It was Donald Trump. He signed it and the law changed. So that's where this started. It started from loosening up policy again. And that was Greg Becker that made a huge push towards that. Fast forward, Greg Becker, he gets on the Federal Reserve Board of San Francisco. Yeah, he's one of the regulators. And so things just continue to get worse and worse. Now, I want to show you some price charts, both regional banks, the whole financial sector in the US, and some other major banks that cannot fail or are called too big to fail, which was the whole point of Dodd-Frank, is to make sure there's never one bank that could pull down the whole system. But before I do, I just want to point out a couple things that happened at Silicon Valley Bank because it's important. They had no chief risk officer from April of 2022 to December of 2022, also known as 7 months. Now, let's actually do this. Let me jump over and show you a price chart of Credit Suisse, not Credit Suisse, but Silicon Valley Bank here, because I need to show you this. So look at the screen. You basically have look at that, no risk officer at the 16th largest bank in the United States, none. They don't have a chief risk officer here. Now, they finally got one in December, but I think your brain can see that it was already too late. That's right. So the 16th biggest bank in the United States had no chief risk officer. That's probably not a good thing. Yes, Greg Becker was removed from the Federal Reserve Bank of San Francisco, but it's kind of a moot point right now. So we know that Silicon Valley Bank has gone bust. So same thing with Signature, same thing with Silvergate. So now the question becomes, what is going on, right? This was not a policy issue. This is not a Fed problem. This was a poor management problem. They were not managing, they being SVB, Silicon Valley Bank, they were not managing their book well. The other thing with this, people think Silicon Valley Bank had thousands of customers. They didn't. They had about 25 customers. And when those 25 customers decided to pull their money, everything fell apart. Now, those 25 customers are VCs in Silicon Valley, and they're all on the same WeChat chat or Signal chat. And they all basically said, oops, this isn't good. Let's get out. And basically those 24, 25, almost all guys said, no, thank you. And they pulled their money. So Silicon Valley Bank was confused with how many depositors they had. They had about 25. Okay, so if you look at the screen here, this is Silicon Valley Bank. Obviously, it's imploded. It's gone. It's done. Depositors will be made whole. Bondholders were wiped out. Equity holders were wiped out. But here's regional bank ETF in the US. This is a problem for two reasons. The first reason is it's below its pre-COVID high. That's a problem. It couldn't even stay above its pre-COVID high, and it is now below that. So it's now in a very, very unstable, dangerous place where now if it tries to go back up, people are going to sell back into that price moving higher. So now this is regional banks. So this is not just one bank, but this is regional banks in the United States. So that is not looking good right now. If we jump over to just to look at financials in the United States, this is where you want prices to stop. You want people to stop selling at $30 for XLF. Now, XLF on this price chart, it's dividends included. So just kind of make note of that. But you really, really, really want to see prices hold here for this sector. It's a very important sector because it's financials. Now, the problem is if it doesn't stop, it has a little bit more buffer with its pre-COVID high just right under it, right about $29. But then it can really, really, really fall. And it could fall as low as 17. So it could get cut in half here and still not break below COVID low. Okay, so a couple other things. Here's Bank of America. This is one of the 5 biggest banks in the United States, one of these too big to fails. This is where Dodd-Frank said, we can't have any one bank pull down the system. I want to point out the 2 things I've been pointing out on all the charts. Here's the pre-COVID high, and it's below it. So B of A is already in trouble. Here's the October low. B of A is already below it. So B of A is a stock that you want to keep your eye on as far as if things are getting more or less stable, which is a lot of what this video is to tell you, is say how to know if things are getting worse, or let's just call it less worse and not better. Now here's Wells Fargo, also one of the 5 biggest banks in the United States, and you're going to see the same thing here. It's below its pre-COVID high, not good. And look at its October low. Its October low, it is just below it. This is its October low, and it is below its October low. So the weakness, if you want to know if things are getting more weak, you can watch the price chart of Wells Fargo or B of A. And lastly, I will show you 2 more things, and then we will wrap this up. Here's the US dollar right here. Now, almost everything on the planet bottomed in October of last year when the dollar peaked. Bonds bottomed, stocks bottomed. Stocks are about 100 trillion, bonds are about 200 trillion, right? So 2 major asset classes on the planet bottomed when the dollar peaked. The dollar is moving up again. Now I'm recording this close of market on Wednesday, and the dollar is moving higher. If we see the dollar get back up here and break on this price chart, this is UUP, a ETF, a tracking of the US dollar. But if we see it break that upper blue line, then we're going to have to go back to believing the market's going to fall somewhere between, let me just bring up the US dollar, somewhere between 35 to 55%. So the number on the US dollar is actually 114. If it breaks that, bad stuff is happening. Also, too, the more we see this price chart fall, and it's oil, and oil fell today about 5%, today being Wednesday, March 15th. This might be also one of the reasons why the Saudi National Bank said, no thank you, Credit Suisse. They see oil prices falling. Now, oil prices falling has more to do with, a recession, the world slowing down, China not coming online as fast as everyone thought it would. So that is more of kind of a recessionary type of indicator. So that would be another thing that you'd want to look at. So things are moving fast, right? Stocks are falling. Companies are going out of business. We have the financial turmoil. It's jumped across the Atlantic in a much bigger way. Credit Suisse is a much more important company than Silicon Valley Bank ever was. Now, it only has about 600 billion in assets, but it is more interconnected with Europe than obviously Silicon Valley Bank was. So its interconnectedness makes it more dangerous. And honestly, it probably failed 10 years ago, but the Saudi National Bank and others kind of kept it alive. But this has been a dead man walking for a long time. So just to land this plane, things to watch. The US dollar, if it spikes, that's not a good thing. If oil continues to fall, that is not a good thing. Regional bank ETF care, if that continues to fall, again, another point of instability. And that's what we're doing. We're just simply looking at where there is more instability or more stability. And instability is getting more and more and coming into the market. Now, as of yet, the S&P hasn't really done much. It is still in its sideways mess. But that could easily change very quickly. So you definitely want to make sure that your portfolio is one that adapts to the market, just like Charles Darwin talked about which animals survived. Not the strongest, not the fastest, not the oldest. Let me just say that again, not the oldest. Credit Suisse, 167 years old. Lehman Brothers, 150 years old. These are companies that have been around a long time. I know a lot of people measure safeness on how long a company has been around, and that is a mistake. Thanks for being in my world. Let me know where you think I got it right, where I got it wrong, and please like, subscribe, and leave a comment because it makes a difference. If you're curious what it would look like to have an approach that actually adapts to what is going on, you can go ahead and look into the description and you can get on our calendar and we can talk about how we do that, how we have an approach that actually adapts so you never have another knot in your stomach. You don't have to watch the headlines. You don't have to watch economic news. It's become a burden for people. Thanks everyone for being in my world, and I will talk to you next week. Bye.